Welcome to Golden March Investing. My name is Liam, and welcome to the Larch Fund, episode 6. We are talking about March. We are talking about moving forward. We're talking about sort of this crazy transition time in the Canadian economy. And of course, we're talking about my personal Canadian dividend stock portfolio, which is what I call the Larch Fund. It's the series we've been doing since basically the start of this channel. Now, every time I do one of these episodes, I have a slightly different theme. I always want to talk about something interesting. Today is all about long-term investing and long-term thinking when investing. If that interests you, please do like the video, subscribe to the channel. It makes a huge difference to me, and it doesn't cost anything. Let's start by talking just super quickly about the portfolio. I have a couple of companies in here that are doing great, but I want to highlight the ones that are not. C&Q down 10%. National Bank down almost 8%. CNR down 3%. These are 3 solid, growing dividend payers that I really strongly believe in. And from a surface level, you might think, oh man, that sucks that he has so much money in these companies that are underperforming. But I actually am pretty excited to see those numbers. Because when I look at CNQ, for example, Canadian Natural Resources, that's a company that has been growing. It has physically expanded. It has acquired a bunch of oil sands assets. It is putting itself in a position to be by far and away the largest, most dominant Canadian oil sands player at a time that I think that's a really interesting space to be invested in. Because there's all these question marks about what exactly is going to happen to the Canadian oil market and you know, the growing debate, I guess, about Canada diversifying our export market. Really interesting company to be in. I think they are going to be a winner because they are large enough. They have the scale, they have the ambition to take advantage of downturns in the market. We've seen that in the past, over the past 5-10 years, through this sort of downturn in the Canadian energy cycle. They have acquired huge amounts of assets, have grown massively, and have put themselves in a huge position to capture the upturn that we're sort of in right now, probably started in 2021 into 2. And they've done a really good job. If we see another downturn, I believe they will do the same thing. They will push their size, their ambition, their leverage to acquire more assets and consolidate even more, become even more efficient, even more profitable. And they have like a fantastic ability to weather any storm in the oil market. I am going to do a video talking about that company. But when you see this in your portfolio, as a long-term investor, that's just gravy. Seeing that it's down, I get a cheaper price than I was already willing and more than willing to pay. And I get to buy more of it at a cheaper price. Like, that's fantastic for me. And I think that's core to what I'm talking about today. And I really think a lot of what this comes from is straight out of the book that sits right beside me all the time, straight out of The Intelligent Investor by Benjamin Graham. Because in my personal opinion, dollar cost averaging throughout the lifetime of a portfolio is critical to really have a long-term mindset and to really invest in a smart and positive way for the long run. Because most of us are normal, emotional humans with regular lives, right? There are some people out there that are really, data scientists and can really make emotionless decisions and just think critically about every investment decision they make. But the rest of us are people. And when we see things that aren't going well, it's really hard to be like, yep, that's where I want to be. I'm going to put my life savings into a company that's not being successful right now because I believe they will turn it around, right? And so we're incentivized to pay a higher price for our companies because we buy into things that are doing well. And we pick up on other people's advice and on trends that we understand and on companies whose names we recognize and whatever it is. And we end up looking at this, stock market. And if this was my universe of stocks, right? If these were my only choices, I think it'd be pretty obvious I'd be buying Enbridge today. But I'm not. Instead, I want to be buying C&Q, and I want to buy them at intervals. Because when I buy things over time, I give myself the best average price. It's the same way that when I invest in Enbridge, I don't do it all right now while it's up 20%. I've done small purchases over time. That's critical for a real long-term mindset. Another thing that's really important in my opinion, is developing a strong thesis. And I almost want to do a video just talking about this idea on its own, because I don't know that a lot of my generation of investors, young investors who grew up in the internet age, really have the opportunity to develop an independent stock thesis. I personally am a huge consumer of stock market media. I mean, it's obvious. I talk about stocks on the internet. I have to be, but I love watching people's YouTube channels, talking about different companies, different strategies, different portfolios. I love reading articles, be it from like a Seeking Alpha or on a news site or on Reddit, of people talking about their bull theses, about what they believe will happen, about, economic trends, whatever it is. I really do consume a lot of media. And so it makes it really difficult for me to make unbiased decisions, because my decisions are going to be based on that person's YouTube video and that person's Reddit post. And I'll see those two things and they will change the way I think about a company and push me towards investing, or change the way I think about a company and push me towards not investing. And it's tough to just look at a company, to sit there and read through financials and read through earnings reports and go through whatever analyst data you can find and make an unbiased decision. It's really hard to do that. And so I think there needs to be a little bit more conversation about investors building their own thesis about companies. Because when you borrow conviction, for example, if I go to Financial Education, one of the biggest stock market YouTubers, he talks about stocks most of the time, and he talks about his favorites. He talks about the stocks he's buying, and he gives maybe not recommendations, but he talks about positive stocks that he thinks are going to do well. If I then go and I jump onto a company, maybe I'm borrowing conviction. I'm investing because I believe in that creator. And that makes it really difficult for me to then hold that stock if things go wrong. Because my conviction in that company is not based on my own research and my own understanding. It's based on somebody else's. Now, again, I am in the space of stock market media. I'm not saying you shouldn't consume it. I'm saying instead it's important that you remember everybody needs their own thesis to make long-term investing work. And so when you see a creator talk about a company and you think, oh, that looks good, I think I agree with what they're saying, you do what I do and you independently research the company. I have watched, again, thousands of hours of stock market media, and I always build my own thesis before investing. Otherwise, my portfolio would look way crazier right now, because I would have 60, 70 different companies in there from all of these different stock market creators talking about them. Instead, I take the time, I build my own thesis, and I really, really strongly recommend that you do as well. As an investor, make your own conviction. It's so much stronger than borrowing someone else's, and it lets you look at companies not performing and feel good about it and buy more of them and dollar cost average over time. It lets you make logical decisions over time. A second thing that I think would be pretty good advice for most of us that want to invest in the long term: try and automate things. It's so much easier to make an automatic purchase in if you're Canadian, TFSA, RRSP. If you're an American, maybe your 401k or whatever brokerage account you use, and just leave it to the automation. Maybe pick a couple good ETFs, right? It gives you diversification. You don't have to research any specific companies. You're just sort of broad market indexing it and automating it. That is a really smart way for most people to invest, and it lets you take a long-term mindset. If you're making a couple of percent every few months, and your beta, you're sort of tracking the market, is pretty close to on par, then you'll do really well over time, according to research, according to history, and you don't have to stress about it. And for some people, that might be worth it. I love talking about stocks. I love researching stocks. Lots of people don't. Lots of people just want to build money and retire. That's it. They want to build real wealth. And for them, automating things makes it even easier because, again, you don't think about the numbers. You don't look at the portfolio every couple of days. I think there's lots of other things I could talk about here. I'm going to do a video where I talk about some of the sort of super investors, the Warren Buffetts of the world, and some of the things they do to sort of adopt a long-term mindset. But I think for this video, talking about this portfolio, I just think it's really a correct time to be having this conversation. And why do I think that? Well, again, the Canadian market, at the very least, is quite shaky right now. There's a lot of fear in the market. On Blossom Social, which is a great stock market app. It's like a social media specifically for investors. It is Canadian, I believe. I believe it's Canadian owned. At least the creator is a Canadian content creator who does a lot of really great work. And there's lots of great people on there. I post on there. I usually upload these videos. I post some like polls and stocks and talk to people about stuff. On that app, they have a fear and greed indicator. They basically show how are people thinking about the market. And we are in extreme fear right now. Extreme fear. And what I thought was really interesting is that a full year ago, we were in extreme greed. Let me show you why I think that's interesting. If I jump back over to the screen here, if I click on the S&P 500, and let's say, okay, right, everybody's fearful right now. Right now, the SPY is at about $600. Full year ago, they were greedy. Well, what happened a year ago? S&P 500 was sitting at $511. So stocks are way up and folks are quite fearful. But even more interesting is that if you look at the last few months, ever since that huge pop in November, S&P is just about neutral. It's gone up, it's gone down, and you see some pretty big jumps here, but the market's just been coasting. And I think that speaks to the sort of yin and yang of the overexcitement about the market, about growth, about AI, about tech, about the potential for the economy that has been sort of raging for the last couple of months, and then the fear of change, of bad policy, of recession, of interest rates, of inflation, of tariffs, whatever you specifically might be impacted and whatever your specific companies might be impacted by. We've seen this crazy pendulum swing from greed to fear. And I think it's making a lot of investors question their strategy, because some of these people decided that they were going to follow others into things like Palantir, Nvidia, Tesla. And well, depending on when they bought, they might still be up, right? If they bought in October, they're probably doing great, right? You buy in the middle of October, you're probably having a great time. But if you bought at the peaks, right, maybe end of December for some of those companies, maybe into January for some of those companies, yeah, you might be looking at red. And if the only reason you bought is because something's going up and you have a short-term mindset, you just wanted to make a little money, you're doomed. And so as a long-term investor, I wasn't really buying a huge amount of companies in the middle of January, in the middle of December. I had my dollar cost averaging going, of course, but I wasn't jumping into new positions or throwing extra money at the markets because I understood that things don't usually go straight up for the long term, and that the Canadian economy specifically is in a weird spot. But I'm not selling because, again, I am a long-term investor. 5 years of downturns in Canadian stocks is a good thing for me because I have another 15 years after that for my positions that I will now have built at a lower price to make me money. I just think it's really a good time with all of the crazy emotions in the market to just think long term, to take yourself out of the fear, take yourself away from the media, make your own decisions about companies, make your own investment theses, and think long term. That's just about it. That's about all I have for you folks today. I hope you enjoyed it. I will do another video talking a little bit about long term thinking, but I'm going to talk a little bit specifically about what super investors do, like Warren Buffett, Charlie Munger. So keep an eye out for that. And if you like this kind of content, you made it this far in the video, you like talking about stocks, you like talking about investing, specifically Canadian investing, but also, we talk about American companies on here too. Please do subscribe to the channel. Makes a huge difference. Doesn't cost anything. With all that being said, I hope I see you in the next one.